And you know what? We've got one of Renatus's best. I mean, he is a seasoned real estate investor, an amazing individual who has brought to the table so much in, 9 years now that we've been in business, and he's been teaching and training for us. And we're thrilled to have him as our special guest today because he always has an insight as to, what's going on in the real estate market and how we can best position ourselves to capitalize on that. It's none other than Mr. Chris Wilson himself. And it's kind of fun to have, Skylar out here doing a little edification of Chris and trying to get some brownie points. Well, I'm going to try to get some brownie points too, because I want to be on this good side of this man forever. So Chris, the call is yours, my friend. Come on out.
Hey, Bob, how are you doing?
Outstanding, man. It's good to see you.
Yeah, Jay nicely apologized for me, but to all the Renatus Nation out there, it wasn't Jay that was slow, it was me. They say, can we live in interesting times? I don't know if we can get much more interesting than we are right now again. In some ways, it's day by day. I just coincidentally, I got my TV on in here and ABC News in the background. They just had Mayor Cuomo, or Governor Cuomo from New York on. And for those of you that haven't been watching this, last Friday, Saturday, and Sunday, this past week, he's been telling Trump to stay out of New York, let the state handle the COVID problem. Today, he's out there crying because the state can't handle it and the president needs to take a leadership role. And really, that uncertainty that creates with those attitudes is what's impacting our market in so many different ways. From the uncertainty with the stock markets, we've all seen what happened with the Fed, right? The Fed lowered the interest rates to practically zero and stocks fell all day. Matter of fact, trading was suspended twice on one of the markets. The problem is we don't have a financial crisis right now. We have a confidence crisis. And rather than ruling with cooler heads, we're letting fear and uncertainty dictate what's going on. And one of the best articles I saw recently is the confidence crisis can be pointed at four different things. The Fed and the Fed rate policy is causing stocks to be nervous. When the Fed came up last 2 weeks ago, an emergency meeting and lowered the rate 0.5 point, and then they came out in another emergency meeting Sunday and lowered the rate to zero, it makes investors wonder what they're missing. Second, obviously, look at 1.1 billion minutes of news time for the COVID-19. Nobody really knows what's going to happen with that. I'll come back to that. And then last week, everybody was saying it was the Arab and the Russian oil war. But we've known about the Arab and Russian oil war for almost 45 days now when Russia walked out of the OPEC meeting. So that shouldn't have been a surprise, but for some reason, people think it is. Add in one more thing, the uncertainty in the election year. We've got four big things that are making investors uncertain. There was a really good article written in the Wall Street Journal back the first of the month that talked about the uncertainty when Bernie Sanders looked like he was going to win the primary. And Wall Street wasn't reacting well to a socialist winning a primary. That shouldn't be a surprise to anybody. Now it looks like Joe Biden's going to win the primary. But one of the articles I read this morning was talking about the Democratic debate last night. And the gist of the article was neither person put out a comprehensive plan for how they would fix the problems and move forward. And they were critiquing them. And the end of the article said that makes investors more nervous. Sure. So let's just sum up the market now. We're scared. And we're all worried we don't have enough toilet paper, so we're running out and buying more. I don't know about where you live, but here in Arizona, Maricopa County Sheriff told us not to leave toilet paper and bottled water in our cars because they might get broken into. Is the stock market going to impact the housing market is what we're concerned with. And if we take it a step further, we kind of have to look at the stock market and say, is the stock market fall? Obviously, it's real, but should it be real? I mean, basically, the same people talking about a recession right now and talking about the stock market collapsing and going into a bear market instead of a bull market are the same people that 2 months ago were saying 2020 was going to be a fantastic year with record profits. But now that things have changed, they've changed their tune. The Dow the Dow is priced in the major economic collapse already. So why is it still collapsing? The problem I have is the majority of economic data for the US that doesn't support this distortion in the Dow. And when I start looking at housing markets, what I'm concerned with is what's happening with jobs. And the jobs numbers just came out last week. Unemployment, short term, down. Short term has been going up for the last 3 weeks. It went down. Long-term unemployment went up the last 2 weeks. It went down. So people are working. If people are working, the next question we have is, are they making money? We've already seen at the end of last year that wages grew. And wages grew, which created the growth in the housing market. If you're following it, interestingly, the housing market did not grow more than wages nationwide on average. In some places like Arizona, it did. But nationwide on average, wages grew by 5.4%. The housing market grew by 5.2%. And every quarter last year, and in the first quarter of this year, not counting this month, we could see the same thing happening. Inflation on houses or appreciation on houses was staying just below the job growth and the wage growth. We also not only saw wage growth on the salaried people or the professional people, we saw wage growth on the hourly folks too. We also didn't see mass unemployment when the holidays were over. Normally we go into January and all those temporary holiday workers get laid off, let go. We see the unemployment numbers usually go significantly up. This year we saw the unemployment numbers go down. So as an investor and as a real estate professional, I'm looking and saying we got jobs, we've got income. Let's add in the second part of the equation. What's happening with supply and demand? You know, they released the supply numbers in January for 2019. Unfortunately, it's always a quarter behind. But the summary for 2019 was rather telling for the housing market. There were only 2 markets in the nation out of the top 25 metro areas that saw the inventory of housing increase. Chicago saw a slight increase of 0.3%. Detroit saw a bigger increase of 3.6%. Every other market of the top 25 in the nation saw the inventory decrease. Now, there were 6 markets that saw a single-digit decrease, but the majority of the markets saw well over 10%, most of them averaging between 12 and 15%. As an investor, what does that mean to you? There's a lack of inventory. Now, the talking heads tell you that the builders are going to improve on that. But we also got the home start numbers last week. Home starts are down. Builders are scared too. Their lenders are scared. So the uncertainty is slowing down the building again. We can say builders learned something from 2008 and 9, but we're not quite sure yet. We'll see in the future. But the housing starts are down. But the buyer demand has not decreased. Have we seen a decrease in the last 2 weeks? Yes, we have, but we haven't seen a decrease in buyer demand. We've seen a decrease in sellers wanting to sell. And to look at why we've seen a decrease in sellers wanting to sell, we have to go back to COVID-19 again. Sellers are getting nervous and they're being told 24 hours a day, 7 days a week, that they ought to worry about people coming into their house and having a disease. They ought to isolate themselves. And there's a certain percentage of the buyers that are doing that. And unfortunately, the biggest moving segment of the market is always the affordable +1 housing market, or the starter home +1 is another way to look at it. And those are the buyers that are the most nervous. And those are the sellers that are the most nervous. The buyers are being calm because interest rates are low. And as long as interest rates are low, buyers want to buy. Now, yes, interest rates went up today. I'll come back to that. But last week, interest rates were down below 3.5. So we're back to a seller problem. The answer to whether that problem is going to impact us for real really depends on how long this fear for COVID-19 goes on. We know as the government starts releasing test kits and the more medical testing goes on, we know the numbers of people sick is going to go up. That's just reality. What we're not seeing, because we know there should be more people infected, what we're not seeing is a higher death rate. And if the death rate doesn't get high, but the numbers of people infected go up, people start forgetting about it and stop worrying about it. Right now, they're sitting home with their kids. I don't know about your schools, but all our schools are shut down. They're sitting with their kids and they're all worried and watching TV 24/7 also. Whether they're getting good information or bad information, I'll leave for you to decide. It doesn't matter. It's scaring them. And we've got to do something to combat that fear. Sellers are turning down meetings with even real estate agents, let alone investors. They're refusing to do open houses because they're all afraid. So the question still is, how long will that last? CDC says 2 weeks self-exile. Last week they were saying 8 weeks self-exile. The truth is 6 or 8 weeks isn't going to change the market in any way, shape, or form. The only way that's going to change the market is either we suddenly have a whole bunch of inventory appear and no buyers, which means buyers got laid off and lost their jobs and can't afford houses anymore, or interest rates go up. There's a lot of speculation on interest rates and what's happening to them right now. I'll leave that speculation alone. Interest rates aren't going to go that high, especially not with the Fed rate that low, at or near zero. So interest rates aren't going up. Buyer demand. In order for buyer demand to shrink, the percentage of the population that wants to buy a house, which is somewhere around 84% of aging millennials, as well as 79% of baby boomers, they're still there. They're not going anywhere. And millennials are the largest growing group in the nation with immigration. So they're not going anywhere. That demand is still there. So the buyers don't go anywhere. The builders aren't going to build enough homes to replace the resale homes. So we still have a high demand, low supply market. If we look at the housing market and we really take a good look at what happens to it in years of recession, assume this is a recession, I don't buy that, but assume it is. Generally in the housing market, when the market goes into recession in the financials, housing rises. And you couldn't say that's the leading edge of the curve because people don't realize it's sunk and they're still buying. We saw that happen in 2006, 7, 8, and 9. So we've got a leading edge on the curve that's 2 or 3 years. If the market recovers in 8 weeks, take the 8 weeks, 2 months, 60 days, what does it impact? We're still in the same market we started the 2020s in. If we look at Freddie Mac's data and NAR's data, they agree with the data coming out of the recession pickers. Freddie Mac and NAR say housing price appreciation continues during a downturn at an even pace, and existing home sales grow because the builders slow down their building. One of the things that we need to understand about this housing market is it wasn't created like the last one with Phantom Credit. So every time George Stephanopoulos goes on TV and tells you we've got a housing bubble just like the 2008 bubble, which was actually an 06 bubble, but it's George, so we'll forgive him for that. It's not. This market was built on solid lending practices as a result of what happened then. People are paying their mortgage. The average home buyer in today's market is not putting down 0%. And by and large, the average home buyer is paying somewhere around 17 to 22% of their income for their mortgage. Go back to 2008 and we're talking about 25 to 33%. Big difference. So can somebody take 2 weeks off and lose their mortgage? Sure. Are they likely to? Not really. And by the way, if that happens, for those of you that don't know about it, the Fed has a forbearance process for COVID-19. They announced it Wednesday, or they announced it Saturday. If you can't make your payments because you've got to go into shutdown or you got to stay home with your kids and you're not getting paid, Fannie Mae and Freddie Mac have a forbearance program just for you. And I'll mention one more positive out of COVID-19. Talk to Mark Kohler. There's some tax advantages if you're a business. So if we have inventory issues and we have buyers, should the housing prices come down? Probably not in the short term. If we really want to look at the numbers that are fueling the economy, a month ago, we were expecting the annual appreciation to be 5%, give or take, nationally, in both 2020 and 2021. So all the naysayers that were saying the market was going to collapse, most market adjustments in housing is 10%. So if they waited until next year to buy a house, the house they were buying would be the same price as it is right now. Now, has COVID-19 changed that? We're not seeing depreciation, or we're not seeing reversing of housing prices. What we're seeing, and I'll just sum it up. We have one put on the market Friday. Today's Monday. I've got 9 offers on it for progressively higher prices. It was on for $167, which is very affordable in Phoenix. My highest offer is $189. So we're seeing the same thing we were seeing before the market started, but at a slower rate. My business for this real estate brokerage that I'm sitting in right now, we were expecting this month to be about 30 million. And we saw in the last 2 weeks, we've seen business fall off 45%. We saw it come back about 2 or 3% today. We're hoping it comes back a little more before the end of the month, but it is what it is. That buyer demand that fell off has to go somewhere. And as long as the coronavirus scare gets taken care of and the news media quits doing 24/7 reporting on it, you would expect April and May to go up. Number 2, home ownership wasn't so important to the millennials a year and 2 years ago for some reason. 42 million of them have hit 30 this year. And suddenly home ownership has become important to them. As a matter of fact, out of those 42 million that are hitting 30 this year, 92% of them say it's time to buy a house instead of renting. That's a big number of demand for housing. This week's forecast for existing home sales and retail sales is up. Existing home sales were up. They weren't up a lot. I mean, normally we're used to seeing them up 1 or 2%. They were up 0.1%. New home sales were up 0.2%. New home starts were down 0.5%. Just if you like numbers. What's interesting is mortgage apps. Purchase mortgage apps for the month of March went up as of 3/13, week ending 3/13 went up 6%. And refinance apps went up 79%. So remember we were talking about the mortgage rate and how last week it was down, this week it's higher. One of the things we've been answering questions on all day here between the lender that in our building with us and most of us that do a lot of real estate is, shouldn't we refinance because interest rates are 0? Interest rates aren't 0. The Fed rate isn't what you borrow money at. The Fed rate is what the bank borrows money at, and they still have to make money. Let's be brutally honest here. The banks aren't going to loan you money and pay you for taking it out. That's not happening. there's still an interest rate number. The interest rate number last week was between 3.4 and 3.5. As of today, the interest rates ended the day at 3.72, which was actually down from the high for the day of 4 for a fixed rate mortgage, and 3.58 for FHA and 3.59 for VA. The rates, if you're looking at them, bounce anywhere. There's some places out there still saying they want 4.25. If you're thinking about doing something with interest rates, watch them. They'll go down again. But as long as we've got 6% increase in new home purchase mortgages, and we've got a 79% increase in refi mortgages, why are they going to put them down? People are using them, they stay up. The interest rate on homes is based on market demand. A couple other numbers that you might want to watch. The CPI is up. Everybody's afraid, but the CPI is up. Now, I had somebody mention earlier that's probably because everybody's buying toilet paper, water, and everything else the stores sell. Maybe, but it's still up. As long as the CPI stays up, the consumer price index stays up, you cannot go into recession. And unless it goes up a lot, like over 3%, you can't go into inflation. So start looking at the numbers yourself. One number that did tumble was consumer sentiment, and that shouldn't be a surprise to anybody. Consumer sentiment's been hanging around 101, 104. Last week it went down to 95. I'll just leave that alone. One of the things that I think we should be watching, besides interest rates, make sure you're watching jobs and employment. We've seen with this crisis created by the coronavirus, that most people didn't have enough food to survive 2 weeks of lockdown. So you have to question whether they have enough money to survive 2 weeks of not working. One step further, you have to wonder how the working at home version 3, I'm going to call version 1 1980, version 2 1990, we'll call version 3 now. Version 1 and 2 failed by and large. People didn't really work when they were at home. And now they've got their kids home too, which is really hard to work. How is the working at home going to affect their production? And because we have just-in-time delivery on all our products, how is the lack of delivery going to impact our production? If the just-in-time delivery can't deliver pieces to build the product, then we start seeing the people that build it getting unemployed. That starts hurting the market. Can we weather 60 days? In my opinion, yes. 2 years ago, I was talking about the housing market was too high and it ought to start coming down. It was. Last year, the housing market was too high and ought to start coming down. It was. In both cases, why didn't it come down? Because jobs and employment rose to cover it. And as long as those stay in sync, we're good. One other thing that's a little worrisome that New York is seeing, and the only reason New York didn't have an increase in inventory is because the increase in inventory in New York City and the boroughs was countered by the lack of increasing in upstate New York and the non-borough area. There's a lot of emphasis on changing rental rules, whether it's the maximum rent increase from California or the no eviction policy of Seattle from October to March, or right now, California, Los Angeles announced today that you can't evict during the coronavirus, or it's the rent control process that's being pushed nationwide. All those rental rules are changing how the investors want to invest in rental properties. And although we're not seeing a downturn in residential rentals yet, For the last 4 months, we've been watching it because we've seen one in New York. We've seen one starting in LA. We've seen one starting in San Francisco. All those policies are making the big investors nervous, which puts more property on. Now, once the big investors get nervous, remember they own a lot of rental property that's not apartments too. If they get nervous and pull out of those pro forma rentals that they created with pools of single-family residential homes, it may impact the inventory hitting the market. It'll be positive for the buyers, negative for the sellers. That will cause the market to flatten. One other thing I wanted to talk about before I finished up here is NAR's clear policy, NAR's clear cooperation policy. There's been a lot of questions on that. NAR, National Association of Realtors, I'm sorry. NAR's clear cooperation policy goes into effect in May. In most places, it goes into effect next month, April. For people that are members of the MLS system, you do not have to be a real estate agent to be a member of the MLS system. For people that are members of the MLS system, the fine for not following that policy is anywhere between $250 and $500 a day. That policy quite bluntly says any property you take as a listing must go on the MLS 24 hours, within 24 hours of when it's publicly marketed. Now, publicly marketed as a brokerage means outside of my brokerage. I can market it within my brokerage and agents and within their clientele, because in the brokerage environment, those are all my agents and they're all my clients. Once it leaves my brokerage, which includes putting a sign up, putting out a flyer, sending somebody an email that's not already doing business with me, that's leaving the brokerage. It must be listed within 24 hours. There was a rumor out that said the owner can exempt out of that. That is not true. The owner cannot exempt out of that. And when it goes into the MLS, it must offer compensation to the selling side of the property. There is no negotiation on that. There is no room for any maneuvering. It's pretty cut and dried. That's the bad news. The good news is it only applies to residential homes. It does not apply to multifamily. It does not apply to commercial. It does not apply to land. Only residential homes. The theory behind it is you're helping the sellers get more money by opening it up to more buyers. I'm not going to argue that. It's the rule that they're using, and it's what they want to do. I think that's, in a nutshell, kind of sums up what's going on in the market. I tried to keep it quick so I didn't run you over time, Bob, like I normally do.
No, Chris, you did a fantastic job, man. So you gave everybody a whole lot of facts and figures. So, Mr. Seasoned Real Estate Investor, where are you putting your money right now?
There's one other thing I didn't talk about that I ought to warn you about. The world of wholesaling is changing. We started seeing it. Most people think last year in Illinois when they said if you did more than one deal, you had to be a real estate broker. Illinois doesn't have agents, so you had to be a real estate broker. But we're seeing it more than that. There's the California 1-3-10 rule, which says if you buy it and hold it too short, you can only mark it up 1% plus what you invested in it. If you hold it for a certain period of time, like over 180 days, then you can do 3%. Or if you improve it in any way, you can do 10%. Well, most wholesalers don't improve it, right?
Right.
So you can forget the 10%. And we're seeing more of those rules come around. In today's market, if you have the money, I would be buying rental properties. Because here's what happens. We got all these people that can't afford to buy a house. They've got to live somewhere. And by and large, what ends up happening is until the credit situation improves or until the fear improves, they move into a rental. Now, why a rental house versus an apartment? Usually I like apartments. Apartments kind of meet the federal guidelines for how you have to maintain them for COVID. And I don't really want to buy an apartment complex and have to go in and have the germ guy come in and aerate the entire building. I mean, you're talking about 2 or 3 months of lost rent, rolling figures across the board. It's just not a good thing. Where if I have to do that for a house, it takes a day. I delay the move in one day, the house is clear and everything's good. There are companies out there that come in and do that de-germing right now. Coronavirus isn't new, by the way. Look at any can of Lysol. It says it takes care of it. So for me, if you have the money, rentals are the way to go right now. And if you're actually following the market, not so much because of this, although if people are laid off a little bit, this may impact them more. There's a whole bunch of people that did the final groups of workouts from the prior problem. Their loans are adjusting, and a lot of them aren't adjusting. They're not paying. So we've seen a slight rise in foreclosures again before the COVID virus even hit. We may see a little bit more of a lift from that too, because after all, you tell people that they don't have to pay their mortgage, which some of them think they were told last Friday, and they don't have to pay their rent. They don't. So we might see a little bit of a more hit on that, which might give investors an opportunity to get in and buy the house, especially if you can come up with a good story and a good program that alleviates the fear of having people come into the house that might have the virus and might infect the house.
Well, sound advice. I'm with you, Chris. I mean, I've been telling everybody for years, I am not a fix and flipper. I really stink at it. But, I mean, I've got vacation rentals. I've got residential property. I've got commercial property. And, whenever there's any kind of a scare in the economy, I sleep well at nights, because all that means is that the rental pool is going to enlarge and my selection of quality tenants is going up.
Right.
So that's the beauty of it. The rest of it, you make money with real estate in a lot of different ways, but I love my rentals.
We just rented a house to two guys, two friends. They wanted to buy, but they couldn't quite get their credit ready. Good Lord, it's been a long time since I've had a renter come in and sign a 2-year lease that was making 120% of what he needed to rent the house.
Yeah. Yeah. So
it's a good rental time. Vacation rentals have their own unique issue too right now.
Yes, they do. They do.
As they're trying to regulate those.
Yeah. Already, well, there's the regulation. There's just the COVID-19 thing. There's a lot of cancellations right now, but we'll get past that pretty soon.
Yeah, but there's a lot of other stuff going on that you can use temporarily. Like go talk to your local insurance company and see if they need some temporary housing for people. Stuff's still happening. It's more than just a weekend rental. You can't quite get as much money as you get for a week rental, but you're still talking about 2 to 3 months rental. So you're still talking about a premium rental rate.
Yeah.
But it'll help you get through this downturn.
Well, that's why I love
it lasts that long.
All of my buddies that have got their money in the stock market are freaking out right now. And I'm like, why? I'm not worried, man. All my money's in real estate. Why would I need to be concerned? And I like sleeping well at nights, knowing that, my entire future is not fading into the sunset because of rumor, innuendo, or some sort of economic downturn.
Yeah, panic, insanity. And I mean, if we had to pick on what's going on, the stock market people, the investors, they're looking for somebody to provide leadership, direction, and vision. But at the same time, they're all panicked and they're not getting either one. And we have a panic market. And one of the best write-ups I saw on the Fed this morning said before the market opened, the Fed was going to cause a panic. And this was written up yesterday, right after they announced lowering it. Well, that's what they did last time. Fed can't fix a confidence crisis. They can only fix a financial crisis. And we have a confidence crisis right now.
Well, and that's why we're positioned in the right place, the right time. You said that, we need good leadership. Hey, we've got that, Renatus. say that, we need good vision. Well, gee, our vision of the future has never been clearer in Renatus. And because we've got the technology in-house to broadcast around the world and to build a business from the comfort of your own home so you don't have to be out in crowds, man, I would call that, kind of a unique selling advantage. So I hope you guys are out there sharing the word and getting things done. And Chris, I want to thank you for being our special trainer today and enlightening us all as to, the chaos around us and how there is calm in the storm when you know how to look for it. So,
yeah, I would say for everybody out there, remember, as long as jobs don't shrink and incomes don't shrink and inventory doesn't suddenly appear overnight, we've still got demand. Let's move forward.
Yes, we do.
We're good.
All right, my friend.
But it changes every few minutes if you watch it.
Yes, it does. Well, thanks for being our featured trader. Thanks for everybody joining us. Good day and God bless everybody. Talk to you soon. Bye-bye.
Thanks, Bob.